Okay, let's dive into this. Welcome to The Explainer, friend. I am so genuinely glad you're here today because we're tackling something that, frankly, schools rarely teach properly: how real wealth is actually built. Look, we aren't talking about lottery tickets here or chasing hype or trying to become an overnight millionaire. We are talking about building wealth through ownership, consistency, patience, and long-term investing. Today, I'm going to walk you through your very own ETF investing roadmap. We're going to take this journey together, moving right from feeling completely overwhelmed straight through to finding absolute peace of mind.
Now, if you're watching this, you probably already have a pretty good grasp on the core ideas, right? You likely understand the theory of compound growth, why it's so important to increase your investments over time, and how long-term investors eventually turn their portfolios into real income-producing assets. But as we all know, understanding the theory and actually acting on it are two completely different things. So let me ask you, are you waiting for the perfect time to start? I want to gently challenge that hesitation right off the bat, because starting early matters so much more than finding the absolute perfect time to jump in. Understanding how ETFs work is incredibly valuable, for sure, but taking action, like literally getting off the sidelines, that is what genuinely changes lives.
And what's really interesting is that this totally captures why so many people just freeze up. It completely validates your hesitation. For most beginners, the exact moment they open an investing app for the very first time, everything suddenly feels overwhelmingly complex. You're immediately hit with thousands of ETFs, there are flashing red and green charts everywhere you look, the financial jargon is practically impossible to understand, and don't even get me started on the endless, conflicting advice online. It is objectively overwhelming. And this is exactly why most beginners quit before they even start. It's not because investing is impossible, but because nobody ever took the time to just explain it simply.
All right, Section 1, your gateway to investing, taking the first step.
I want to reassure you right now, we are going to simplify this entire process. Taking this first step is actually much easier than the financial industry makes it look. To invest in ETFs, you first need a brokerage account. Think of this as your own personal gateway into the financial markets. Today, opening a brokerage account in the US is incredibly simple and, best of all, inexpensive. You just pick a modern platform. Some of the major ones out there are Vanguard, Fidelity, Charles Schwab, or Robinhood. You can literally set up your account directly from your phone or your computer in just a matter of minutes. And to keep yourself consistent, you can use simple tools like your brokerage's native auto-invest feature or even just basic budgeting apps to put your recurring monthly investments completely on autopilot. It is so accessible now. And this brilliantly illustrates one of the absolute most powerful tools available to you right now: fractional investing. A lot of people are held back by this massive myth in investing, this belief that you need thousands of dollars just to get your foot in the door. You really don't. Many ETFs today allow fractional investing, which just means you can buy a tiny little slice of an asset. You can start with surprisingly small amounts of money while you're still just kind of learning the ropes. The most important step isn't starting perfectly or starting with a massive fortune. It's simply starting.
Moving on to Section 2, the ETF Toolkit, 4 core strategies. So transitioning into the actual investments, you're probably wondering, okay, which ETFs should beginners actually look at? Let's break these down calmly, friend, because this is where the real magic happens. First up, we have broad market index ETFs. These track massive sections of the overall market, holding many of the biggest companies out there. For a lot of long-term investors, these are the absolute foundation because they give you incredibly broad diversification with very low complexity. Next, we have growth-focused ETFs. These lean heavily into tech and innovation for a much higher upside, though keep in mind they do come with a bit more volatility. Then there are dividend ETFs, which focus on companies that regularly return profits directly to you as income. These are fantastic for stability. And finally, sector ETFs, which focus on specific industries. It's really all about finding that personal balance of stability and growth that fits your own long-term goals. And speaking of those specific industries, let's briefly touch on some common sector ETFs. You can target areas like technology, healthcare, energy, artificial intelligence, or cybersecurity. These specific sector funds allow you to target areas of the economy that you strongly believe are going to grow in the future. It's a really cool way to lean into the innovations you personally believe in while still taking advantage of that protective ETF structure.
But okay, before we go any further, I have to point out a major beginner mistake. So many people put absolutely everything they have in one single investment. One stock, one new trend, one prediction. Betting on one single stock creates massive vulnerability and completely unnecessary individual risk. Smart investors understand that comparing that approach to diversified ETFs shows a literal night and day difference. Spreading your investments across different areas of the market is how you spread out and actually manage your risk.
Listen, nobody has a crystal ball. Nobody can predict the future perfectly. That's why diversification is your ultimate safety net. It reduces the damage to your portfolio when one specific area of the economy struggles while still allowing other areas to keep growing. This built-in safety mechanism is exactly why ETFs became so wildly popular in the first place. They make diversification incredibly simple for the everyday investor.
All right, Section 3, the mental game, surviving volatility.
Now that we've covered the mechanics of it all, we really need to shift to the emotional reality of investing. Because I have to warn you, it's so important to stay realistic here. The stock market does not move in a straight line. Some years will feel incredible, and other years, they're going to feel deeply uncomfortable. You are inevitably going to face headlines explicitly designed to cause panic. You'll read all about recessions, inflation, political uncertainty, and market crashes. There is always going to be fear somewhere in the news. I want to address these fears directly with you right now. When these scary headlines hit, a lot of people panic and abandon their entire strategy. But historically, emotional control is exactly what separates successful, consistent long-term investors from those who lose out. Staying consistent while everyone else becomes emotional, that is your greatest superpower.
So the crucial point is this: investing is less about predicting every movement and more about surviving long enough for compound growth to work. Read that again. That mindset changes absolutely everything. Survival completely beats perfect timing. If you can just hold on, keep your cool, and stay disciplined through the downturns, compound growth is going to do all the heavy lifting for you. And that brings us to Section 4, the ultimate reward, finding peace of mind. At the end of the day, this whole journey isn't really about staring at charts or constantly checking apps on your phone. It is about a much bigger, much more personal life goal. This right here is the real value of wealth. It's about freedom from constant financial stress. It's the freedom to make major life decisions without that underlying baseline of panic. It's about creating real, tangible options for yourself and your family in the future. Now, money doesn't solve every single problem in life, of course not, but financial stability creates incredible breathing room. It gives you the space to just live. I really want to reassure you, friend, that this is the true purpose of building these long-term habits and sticking to your discipline. For so many people, that resulting peace of mind becomes infinitely more valuable than any luxury item you could possibly buy. Building wealth is simply about taking control of your future so you can sleep well at night knowing you have a solid plan that is quietly working for you in the background.
Most people spend years, sometimes decades, sitting on the sidelines just waiting for the perfect time to invest. But the honest truth is that the perfect time usually feels deeply uncomfortable. The market is never going to look perfectly safe, and the headlines are never going to be perfectly calm. I want to remind you that confidence in investing usually comes after you get experience, not before it. The people who successfully build long-term wealth aren't necessarily the smartest people in the room. They are just the people who manage to stay disciplined long enough.
And that amazing journey to financial peace of mind, it begins with one simple decision: starting. So I'll leave you with this final thought to help push past that analysis paralysis. Which path are you going to start with? Will it be broad market, dividend, growth, or sector ETFs? Wealth is built by those who simply make the decision to begin. Thank you so much for joining me for this explainer, friend. I really hope this roadmap empowers you to take that very first step today.